Dennis, we are now recording, so we can start. Welcome everybody. Oh, you're on mute, Dennis.
Okay, so welcome. Good morning, everyone, and welcome to the Kushner report for March of 2022. Today, the 31st of March, we recognize today's the last day of the first quarter of 2022. It's hard to believe we've kind of flown through the first quarter. So we should have some data maybe sometime in the April presentation later in the next month. So what I'd like to tell you is following. At the end of the conclusion of my presentation today, you'll have an opportunity to participate in our Q&A session, and hopefully you will. So let's get started with our program this morning. So the agenda for today will be, I'm going to talk about key economic indicators, the global economy and domestic economies, mergers and acquisitions, significant economic news, and then I want to address the semiconductor industry outlook for 2022. Well, you know, semiconductors has been a real concern across the board over the last 2 years, especially since we've had the pandemic. So the Gartner report basically reported that worldwide revenue grew last year 25% in 2021 to over $500 billion. And that's the first time we've hit that mark. However, shortages have appeared throughout the semiconductor supply chain, specifically in the automobile industry. So the combination of strong demand as well as logistics and raw material price increases drove the semiconductor average prices up across the board. So we're feeling that across all vertical markets. Samsung regained the top spot from Intel for the first time since 2018. And their sales increased by 32% last year. And at the same time, that's around $74 billion. New plants are beginning to sprout out all over the United States. Since the pandemic impacted the world supply of semiconductor products, the lack of sufficient supplies of chips has really negatively affected the automobile industry, cell phones, and other market devices across the board, substantially causing a lot of shortages in supplies, plant closures, as you know, layoffs across all sectors. And you can see that in Japan, they closed 14 automobile plants earlier in the year. And in 2021, Intel, however, announced that they will be spending $20 billion to build 2 new chip factories called fabs in Chandler, Arizona. So the news comes during the global chip shortage that is staring all of the industries, especially in the automobile industry, where we've seen low supplies of new vehicles. In addition, Arizona has landed the first U.S. site of a Taiwan semiconductor manufacturing company. And that will build up to about $12 billion near Phoenix, Arizona. And it also was found that there's a chemical chip factory that's going to be built in Arizona as well, and they'll start cracking ground on that later in the year. So a lot of plants are being built in Arizona. Samsung Electronics has also stated that they're going to build a $17 billion chip factory in Texas, and is expected to crank out top-end semiconductors that are required for 5G cellular networks, self-surfing cars, and artificial intelligence. So we're starting to break ground and bring a lot of this technology back. And I'll explain to you more what's going to happen in the job market going forward. Intel has committed another $20 billion to build a manufacturing site somewhere near, it's called Albany, which is located in Ohio. So the plan is, their purpose is this: they want to build a new Silicon Valley concept in Ohio. So in other words, they're moving a lot. When I worked in the Bay Area years ago, Intel said they were no longer going to expand their business in the state of California. So that's where they're going forward. They're not going to expand here. And basically, the building of the new plants is going to take time to come on board and improve the U.S. market conditions over the next several years. But in time, we'll be more self-sufficient. So the semiconductor outlook for 2022, the industry is expected to grow by 10% and really reach about $680 billion in 2022. So chips will even be more important across all industries, driven by increasing semiconductor content in almost everything we see, from appliances to your cell phones, to your wristwatch, everything. So this is where we're moving to high tech across the board. So keep in mind, we are in a period of strong growth, especially toward 5G, when that finally gets rolled out over the next 3 to 4 years. Now, it's interesting across all vertical markets, the absence of a single critical chip, one chip, often costing less than $1, can prevent the sale of a device that's more than thousands of dollars. So the semiconductor shortage basically cost the automobile industry last year over $210 billion, and that won't be recovered. So, in the annual semiconductor sales, first of all, sales of chips traditionally trend up with periods of contraction. We've seen that over the years. However, the advancement of technology has really accelerated the demand for chips, throughout most business sectors. So more and more products have at least some chips integrated in their design every year. For example, the advancement and utilization of numerous chips in automobiles and trucks today in our environment makes it even more complicated to service. So imagine taking your car into Mercedes or BMW. The technicians working on your car have really got to go through extensive training, and it's going to continue going forward, other than just changing oil and rotating and balancing tires. Furthermore, where more connected devices are at our homes or offices, almost in every box in a warehouse, chips are also rising in value and capability. For example, the content in chips has doubled. So from 2013 to 2030, you're going to see even tripling the amount of technology that'll be placed on chips. So the revenue and earnings and cash flows are strong from chip companies, really allowing ongoing investment into new plants, new business models, and accelerated digital transformation. So the outlook, guys, for the chip demand, revenue, and profitability will continue to escalate going forward, regardless of the worldwide economy. However, industry experts agree that the shortages will continue for the time being, and front and foremost and center will be this year. However, there will be longer lead times for some of the components stretching into 2023, and we may see this even going into 2024, where some components will be somewhat restricted. Now, here's the real underlying factor for those of you in Silicon Valley. So, for example, talent. So the ongoing talent.
Dennis, you're muted again.
The talent shortage will even be made more severe by the addition of increased semiconductor manufacturing facilities outside of Taiwan, China, and South Korea. There'll be a high demand for soft skills required to program and integrate chips into the various markets in all vertical markets, such as electric vehicles, robots, home automation, artificial intelligence, and 5G. So overall, there's going to be a major shortage in labor. So keep in mind, we have an aging population. We basically have expertise and experience leaving the workforce. And the biggest concern is the post-pandemic work shortage that we're seeing now hitting industry. So you've seen what's happened in Silicon Valley. They've gotten a lot of H visas, bringing a lot of people outside the United States to work throughout the technology industry, because we can't get people taking classes to qualify in those jobs coming out of US institutions. So that's got to change, because we're going to have a tremendous shortage going forward. And finally, the semiconductor companies must strengthen their collaboration with extended supply network partners so that they can better implement integrated artificial intelligence, edge computing, that is build and run applications, and 5G communications. So the transformation of the marketplace will continue as we move forward into 2022. So now what I'd like to do is let's take a look at the key economic indicators. So we've got the gross domestic product, inflation, unemployment at the federal level, unemployment at the California level, and of course, what's near and dear to everybody's heart is the price per barrel of oil. So if we look at the indicators for 2022 on a global basis, they're projecting growth to be somewhere around 4.4%, followed by 3.7% next year. You look at the United States, we're scaling it down to 3% this year and then 2.4% next year. Inflation, as you know, is running high. It's running high, the high sevens right now. But if things take place this year with the interest rates and some other things happening with supply chains picking up, et cetera, inflation should go down somewhere around 5.2% by the end of the year, and then next year dropping down to 3.3. Keep in mind, the Federal Reserve's target has always been around 2%. However, conversations have said last year, for example, that if we move to 3%, that's going to be more acceptable, that 2.2%, et cetera, is really not reasonable. It's no longer achievable. The unemployment picture, the rate now is looking at 3.8% for the year on the federal level and dropping down to 3 next year. If you look at California, we're around 5.3% by year end. We always trail the national average and then dropping to 5.1. Now, this is the one that's the real concern, and that is the price of oil, the range. We're seeing a range as low as $80 a barrel to 125. If you remember a few weeks ago, West Texas Intermediate fuel hit 131. Now, I checked this morning before we got on. So this morning, the price of barrel of oil for West Texas is at $105.11. So when I first did this program on Friday and Saturday, it was at 114. So we've seen it dropping, and hopefully we'll see that continue. And again, you see the stars because things are changing every month. Now let's take a look at the global economy. So the Bank of Canada kicked off its rate hike cycle in March with basically driving up basis points by 25 points. And now they're standing about 50, and they'll continue to do this throughout the rest of the year the way we will. The good news is their fourth quarter and their second quarter of last year were very strong, and that's good. It's the economy starting to come back. However, inflation is increasing the risk that longer run inflation expectations could drift upwards, and we should see more interest rates rise later in the year in Canada. The Central Bank of Europe basically indicated that there's a faster pace of tapering down investments in their economies and so forth. It's very similar to the United States, where we're inducing less money into the economies. But economists believe that they'll start raising rates in April, like we have, by 25 basis points, followed by raises of rates in July and October of this year. And then we'll see rates continue to go up next year. So the rates in Europe in some places will be as high as 1.25% higher than they are now. Also, the European banks indicated that there's a faster pace of growth coming forward as well. The Bank of England, basically their central bank, inflationary pressures continue to build in the UK, and we've seen a real focus on inflation as opposed to stemming back. And a lot of this has to do with the impact of the Ukraine crisis. So they're expecting to see their rates go up similar to what we're doing in the United States. Now, the biggest problem we see right now is the scramble that's taking place for automobile parts because of a lot of these parts were made in Ukraine. So right now, Volkswagen and BMW are two significant companies that are scrambling to find alternative sources of parts for their vehicles. So what we're looking at now, they're looking into China and Mexico to try to move a lot of their demands in those areas. So you'll see that impact inventories of those products around the world and especially in the United States. The hunt for new supplies is the latest challenge for the automobile industry, already reeling from soaring metal and energy prices, supply chain issues, and basically the pandemic. So the automobile industry is just on rocky roads. There's too many moving parts. And of course, in the United Kingdom, inflation rose to 6.2% year over year. That's the highest in over 40 years. Now let's take a look at the domestic economy. As you may recall, last month, the Federal Open Market Committee, for the first time since 2018, raised interest rates by 25 basis points. The expectations are we may say that go up 4, 5, or even 6 times next year. Here's the concern. They're going to come back in with a new forecast on a monthly basis to really take a deep look at what happens if they keep raising the rates. The biggest concern is it could send the country into a recession. So they're going to have to be very careful going forward what that really means. You know, the medium rates this year could go up 75 basis points all the way up. They're talking about even later in the year, raising them again in 2023 as well. So it's note here, the biggest concern we have, as I said earlier, is do we go into a recession later in the year or do we have stagflation? And we'll have to stay tuned to wait and see what happens. Now, factory orders and construction sites, et cetera, again, are still facing supply shortages and very slow activity. So the reports last week said that manufacturing and home building has really slowed down a lot because of the demand for products that are just not available. So the biggest clog in production pipelines continues to be supply shortages. And increasingly, there's no evidence at this point that it's going to turn up in the near future. So again, we're just going to have to continue to see a lot of what we had last year. Now, inflation, I mentioned earlier, the consumer price index rose again. It was at 7.9%. It's the highest in 4 decades. Prices continue to grow. And as you look at the stores and so forth, you see rental costs going up, costs for electricity, everything is going up across the board. And the real concern is that the rapidly climbing costs are hitting consumers in the pocketbook. So, for example, the burden is falling intensely on the lower income housing areas around the country. So you've seen devoting a big chunk of money to budgets. So people are going to have to make some critical contingency plans on how they're going to spend their money. So in some cases, maybe they don't go to Disneyland, maybe they don't go to the films very often, or they don't go out to dinner, but they're going to have to reevaluate where they're going to spend their money, especially with the cost of gasoline going up substantially, and also in the markets for food and beverages, etc. If we look at exports, we had a banner month last month. We exported $1.8 trillion over the last several months. And that included industrial supplies, materials, foods, consumer products, and in some cases, oil. And it's really right now, that's the highest on record. Here's the biggest concern. I told you last year, when we went out in December, we went over $1 trillion for the first time ever in the trade deficit. Well, guess what? Last month, the trade deficit was $108 billion. And if you extend that out, we're talking about maybe $1.2 to $1.3 trillion in the deficit, which is really hurts our economy. So this increase was 7% higher than what we saw the prior month. Retail sales basically were up about 0.3 of a point, and that was below expectations by economists. You may recall we had a run rate of about 3.8 to 4.9% the prior 2 months. Now let's take a look at the employment picture. So we had some very good news on a national basis last month. Payrolls were up by $678,000. You like that? I meant people. So the key right here is that the unemployment rate dipped again to 3.8%, down from 4%, and we've now reached the level pre-pandemic with people in the workforce for 2020. Of significance here is the fact that if you look at business and professional services, they're up by 95,000. We've had 11 or 12 months continually where they've had such strong growth. The other area that is coming back now is construction, which is important. And then again, if you look at health and education, but the real key is watching leisure and hospitality. That's the area that got wiped out during the pandemic. We lost thousands of jobs and it's starting to come back. Those are the people that work in restaurants and areas like that where they're somewhat semi-skilled employees. So that is a key area for us to bring back jobs. Last month, I told you we had a problem with the state of California. They did not put anything out in February for the January timeframe. So I'm going to give you 2 charts today. The first one is payroll was up by 138,000 last month. Unemployment decreased to 5.4%, down from 5.8%. So that's key. The biggest issue we're facing in California, along with the rest of the country, are truck drivers. We need more truck drivers. This is a major problem. You go back a year ago, they were talking about hiring 1 million people to drive trucks, whether they're chemical trucks, food trucks, etc. We lack a lot of truck drivers, and that's slowing down the pace of moving product across the country. Only of significance here is we saw an increase in construction, which is good for building. Healthcare was up, and of course, leisure was up as well. Again, people going back to work, perhaps in restaurants and different places. So that's good for the state of California. And then the January chart, you saw we had 60,000. So from that standpoint, February doubled it. So only significance here was again in leisure. And but the key is that we still trail the national average in terms of unemployment. And it's going to continue. It's been that way forever. Now we'll take a little bit of look. We'll take a look at inflation. Another concern we have right now, as I said earlier, inflation is running at 7.9%. It's the highest ever recorded in the last 30, 40 years. And that's got to change. And so we're going to suffer with this for the time being. Every day you go to the gas station, I was told this morning that there's a place in the Bay Area that somebody paid $9 a gallon of gas in Encinitas, California, which is right near where I live. There's a gas station, don't know where it is, Bill Swan, but they paid $8 a gallon this morning for premium. So we're feeling that. And I know where Dave Lauder lives in Dallas, I'm sure it's a lot less than that. Now, when we take a look, for example, at the other areas, for example, at mortgage rates, I think the key here is that, as you know, it's starting to inch up. So the borrowing rate on average last month was up 4.42%, and that's up from the 3.9 we saw in February. Now, what's happened is the home buyer industry is going to take a hit now. So we've seen mortgages, new mortgages coming on board is down 13% over the last month. And that's going to continue. And that has to do with people either refinancing or first-time buyers. As I told you, in December, 30% of the new homes that were sold were to people that were first-time buyers. And that one area is going to get targeted substantially as interest rates continue to rise. And if we look at the manufacturing index, the good news is it was up to 58.6, and anything over 50 is good. It means we're a strong economy. You may recall about several months ago, we dropped into 49, and that meant we were in the beginning of a recession. And fortunately, a month or two later, we went over that number. So the real benchmark there is 50. Now, taking a look at some other economic indicators, let's take a look at factory orders. New orders for factory goods was up 1.4%. And again, we see that continuing. So we've had at least 10 strong months of factory orders, which is really important for the economy. Small business confidence level dipped again to 95.7. Really, the key mark there is to be over 100. Still a lot of concerns on the part of small businesses, and that's going to continue throughout most of the year. Consumer confidence. Well, as you know, there's a lot of concerns there. It dropped down to 110. It was at 111 in January. Still, we're much higher than the 100. And if you recall, a few months earlier last year, we were down below 100. So it's getting better. I mentioned the oil price a minute ago. When I targeted this on Saturday, it was 114. Today it's 105. But in February, it was $91 a barrel. So you can see how it continues to go up. The housing market, the new construction homes, or for housing markets, if you will, it jumped 6.8% in February. That's a 16-year high. So that's very strong indications in that marketplace. New home sales, basically the new home sales contracted. It fell about 2% across the board. And but basically sales overall fell 6.2% over a year ago for that time frame. So within that time frame, we're down a bit. In Southern California, the good news continues. The home price sales were up by 9.4%. If you look at LA County, home prices dipped by 3.4% to 773,000 for the midpoint, and sales were down 4.5%. Some of that is based upon this time of the year. As we move forward to, as you know, March and April and May, things should pick up. Orange County, for those of you who live there, sales were up by 5.4%. The midpoint of a home in Orange County is now $1,260,000. That's amazing. While sales were down by 5.1%. And San Diego County, the median was up by 1.5% to 888,000, but sales did increase by 7.3%. So that's good news. And the existing home sales, the bad news here is that they dropped down 7.2% last month. So we've still had, in terms of growth, we've had 120 consecutive months of year-over-year price increases. So that's amazing. In other words, 10 years, the prices continue to go up. So hopefully that'll continue. Now, as we look at productivity, as we've talked about in the past, the productivity index comes out basically every 90 days. So we won't see anything probably until sometime late April or May. Get an idea where that is in the industry. In terms of company displacements, the good news is we've had very few companies that have had massive layoffs in the last 12 months. However, first and foremost is a company called Better.com. It's a mortgage lender, and basically they laid off 4,000 people about a week ago. And a lot of that has to do with interest rates climbing. So we're going to see more of that taking place in this space. Now let's take a look at some mergers and acquisition activity that took place last month. Interesting, Sony Pictures Television is acquiring a major stake in industrial media, and it's a major supplier of popularity of TV reality shows, and that's beginning to take off substantially. And there's a lot of things going on with streaming platforms as well. The dollar value of the transaction was not disclosed. AMC is acquiring 22% of gold and silver mine Hycroft. This is kind of a surprise move because they're venturing out of their space, if you will, their comfort level. The mine supposedly has 15 million ounces of gold deposits and some 600 million ounces of silver. So we'll see what they're doing. Again, they're trying to expand their business portfolio, and we'll see where that goes and how successful that can be. In the technology space, Google is now getting into the security space. They're buying a cybersecurity company called Mandiant. It's an all-cash deal for $5.5 billion. Essentially, what they're doing is it's a security company that has consultants and industry intelligent analysts to come on board and fold in a lot of what they're doing into their end-to-end products so they can have a full suite of security products for global products. So this is a major move for Google. In the energy space, Chevron, which is one of our major oil companies, has agreed to acquire Renewable Energy Group. And basically, it's an all-cash deal for $3 billion. Basically, the acquisition is growing of renewable fuels production and leading feedstock capabilities with Chevron as a large manufacturing, distribution, and commercial marketing position. So they're branching out as well, knowing what's going on with fossil fuels. Amazon is getting further into the entertainment industry. They're buying MGM Studios and for $8.5 billion. Basically, they want to expand their portfolio, and they're looking to draw more consumers into their streaming video business. So there's another example where Amazon continues to reach out. So what else is going on? Well, here's the key for Ford. Ford has really gone down several roads in the not to past future. And what's happening here is they're not going to spin off their electric vehicle portfolio. There's rumors that they were going to move out of that portfolio. They're going to stay. What they've indicated is that they see that reinventing themselves to removing a lot of the costs and ramping up a lot of large-scale electric vehicle software sales. So they're going to move more into getting more sales and more software to help with them. As you recall, they have two major trucks. I can't remember the lines, but they have over 200,000 people in line to buy them when they're available. The problem is semiconductor chips. So a lot of these vehicles can't be made and can't come to market until chips are available. We look at the construction industry. What we see here is the fact that total construction, as I said earlier, rose 1.3% in January. So total spending year over year is up 8.2%. You're going to see more of that. The gain in residential spending is really owed to a solid increase in single-family home improvement spending. The improvements in non-residential spending were robust as well. So if you go to Lowe's now, and if you go to Home Depot, if you go there after 8 o'clock, the parking lots are full. There's people buying stuff all day long. It's amazing. People are either working on their own homes or these for new sites around the country. So those two particular companies are doing extremely well. Now we can take a look at our friendly place called Tesla, our electronic giant. So what's happened here is they were sanctioned with a $275,000 fine, and that's because they continuously exceed paint shop pollution limits. So the company's been cited for using toxic chemicals in its plants throughout the country, and it's suspended of causing cancer and other ill effects. So they're going to have to remedy that situation. And then we look at Amazon. If you remember, they opened up some bookstores a couple of years ago. Well, the decision is made now. They're going to scuttle all that. They're going to shut down all the bookstores and other shops as it wants to focus on expanding their chain in the market business. So we're talking about 68 locations being closed in the United States. And finally, we come to Kohl's, which is another retailer that's been struggling for quite a while. What's happened is the company's probably going to go up for sale if it doesn't go into bankruptcy. They've got three major bidders. But if you're familiar with Hudson Bay, it's a Canadian holding company that bought Saks Fifth Avenue. They're also looking at Macy's. So the retail business continues to suffer. So with that in mind, what I'd like to do now is I'd like to open up for questions and answers to get you guys involved here. So why don't we open it up for Q&A?